Welcome back. Let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking this morning?
Well, I'm looking at the crude oil prices. This is one area where you have seen very strong volatile moves coming in as we start a new year. So last week was 2% of gains, but overnight we've seen 4% of a decline come in for the crude oil prices. So after 10% of decline in 2023, 2024 has begun with a negative move already for the first 9 or 10 days for the crude oil prices there. With the kind of decline that we are working with, we are already trading at around 6-month lows right now. Well, 3 or 4 factors which are putting pressure right now. One is the weak demand that we've seen come in from Asia, including China, and that has led to Saudi Arabia cutting their official price to Asia by $1.5 to $2, and this is the lowest that they've done in 27 months for the Asian consumers in sense of official prices there. And then it also is about the rise in output from OPEC. They have been talking about cuts, but when you look at the month of December, 70,000 barrels per day of an increase is what has been noted. So December output stands at 27.88 million barrels per day. The U.S. drilling also has continued to rise, well, 501 as of now, and a forecast of 20 additional rigs in 2024 continues to weigh onto the markets. Remember, U.S. has been producing record crude oil for the last 4 months now at around 13.2 million barrels. Within OPEC as well, it is higher output from Angola, Iraq, Nigeria. So most of these African countries will continue to produce more. They haven't agreed to a quota agreement from the OPEC there. If you look at the global consumption there, and we have seen a bit of a decline come in for that one. For the month of December, it was a sharp decline at 1.3 million barrels. Overall, for 2023, the 1.8 million barrels per day of a global consumption still stands on a taller side there. The Israel-Hamas war and the Red Sea concerns, Syria output halting, all of that has led to premium in prices. But you have to understand that it hasn't impacted the oil output in any way. And the concern clearly comes in from the demand side of it. Because when you look at the numbers from US, Europe and Asia, the demand has seen a decline in the previous quarter, and that would continue to weigh onto the markets. It also has been about the high U.S. gas inventories. The distillate demand in U.S. is the lowest since 1999, and that doesn't help as well. Add to that the fact that the U.S. dollar index is trading on the higher side. The U.S. non-farm payroll data came in better. And the expectation now on the U.S. Fed rate cut for this current quarter really seems to be waning. It was at 90% by mid-December. It stands at below 60% at this point in time. What the street will watch out for is the EIA short-term outlook in sense of global demand and supply numbers. That is going to be important. And the next OPEC meeting now has been fixed for 1st of Feb. So that's another thing that the street will keep an eye on.
Okay, thanks a lot, Manisha, for that. Let's step into